I'm Charlotte McLeod with the Investing News Network, and here today with me is Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Thanks so much for being here today, Chris.
Yeah, thanks for having me, Charlotte.
Chris, the last time that we spoke was toward the end of July when gold was just on the cusp of $2,000 per ounce. At the time, you said you expected some selling and consolidation once gold got to 2,000. And I wondered if the activity we've seen in August and so far in September is what you expected.
It is. I mean, we were looking for that $1,967 an ounce to around the 2,000 mark, which it went up. It just kind of breached 2,000 temporarily, and then it reversed like you and I had talked about. And so since then, it's been pulling back in a very controlled technical pattern known as a bull flag. And bull flags are a continuation pattern. You're expecting a move of equal size continuing higher from this pattern. So we've got a really nice move on this chart. I think we could see 2,200, 2,400 sooner than people think. This pattern is just on the cusp of breaking out this week. The gold miner juniors are forming a similar pattern, and they started to break out yesterday, or more or less this week, early this week. So it's pretty exciting how the markets are evolving and how they've been out of favor and they're really about to come back into favor again.
I was going to ask how long you expect that consolidation period to last. It sounds like it could wrap up quite quickly.
It is. I mean, we could be turning that direction this week. And this trend really could last 2 or 3 months. So it could be a really nice move. Hopefully it'll be kind of a gradual, kind of every week it gets a little bit higher. We don't really want to see price spike up in value because what goes straight up usually comes straight back down. So I'm hoping over a 2 or 3 month window, the price of gold, silver, and miners continue to just slowly work their way higher up to the next targets. And that's what it looks like is happening here.
I don't think we covered this last time, but it does seem worth covering. What's the price potential for gold in the long term? How high can we realistically expect it to go in this cycle?
Yeah, well, there's a couple ways that you can actually kind of predict where price is likely to head next. And if we stick to just technicals, so we're just looking at the price analysis, we've got different levels between $2,600 and then $3,400. Those are what the charts to me are pointing out. 34 being kind of the big high-end price. Now, if we were to go back and bring in fundamentals and what's going on with all the stimulus plans and all that around the world, it paints a very different picture if we're trying to get fair value of what gold should be worth right now and what that worth will be down the road. And that pricing, when you mix that with technicals, comes to around, you're looking at like $7,800, maybe even $9,000 an ounce. So there's a few different ways you can, predict where price is going. I like to follow the technicals because they usually give you a lower price target, something that is more logical. There's reasons why price should kind of stop there or at least reach those targets. And so as a shorter term trader and investor, I'm looking to get in while price is moving up. And then when it hits one of those targets, you can trim some money off and you can see if that price is going to be rejected. Because from a technical standpoint, when these levels are hit, that's when it's most likely to pull back and correct. And we don't want to hold on to something and watch it hit these targets and then fall away and we give back all the gains. So I try to pull some money off at a target and then we watch to see if it's going to create a bull flag, just like what gold and miners are doing right now. If it flags out for a few months, then I know it's most likely going to go a lot higher. So I can put that money back in and try and ride the next wave up. So I can kind of ride the market step by step and step out of the market when it looks like it could come under some selling pressure and I need more confirmation to own it again.
You've been mentioning the miners and how they're moving. I wondered if there are any patterns there that you can talk about. Maybe you could also speak about your investing strategy when it comes to mining stocks. Would you be looking at an ETF or do you ever look at individual companies?
Right. So I keep it really simple. I like to trade ETFs because it holds a basket. You can trade an ETF on the overall stock market like the SP 500 or the NASDAQ. So I like to just trade the ETFs. There's a very low expense ratio, so it doesn't cost much to own it and you still get dividends. Very simple. One trade, it puts you in that investment. And so when I'm looking at investing in stocks, I'm always looking for which sector or what class of investment, whether it's stock, bonds, or a sector, is in a new bull market. So right now, the stock market is still in a bull market, and that's where you need to be invested. But there's new bull markets that have emerged this year, which are gold, which actually emerged last year. And then silver and gold miners have started a new bull market just this year, really in the last couple months. And so those are sectors that you could put some more weighting of your portfolio into. You could take some out of an index ETF, move a chunk of it to the precious metals sector, because something that starts a new bull market usually has lots of upside potential, and it usually happens fairly quickly. So that's what I like to do, is I go from ETF to a hot sector, wherever there's a new asset class starting a bull market. And then when we're looking at the gold miners, the pattern in the charts, they've formed a multi-year basing formation, and now they broke into a bull market a couple months ago. And this is their first pause or pullback. And the first pause of a new trend can be bought, because it means it's really just the first opportunity to kind of back the truck up and get your position before it starts to really take off. So that's where we are with gold, silver, and miners. They all have the same pattern, which is a bull flag, and it points to dramatically higher prices in the very near term, 2-3 months out.
When you're making your trades, do you have a minimum level of what you want to achieve, or are they all individual transactions?
Every trade is a little different, because it depends on how big a pattern is on the chart. The bigger the pattern, the bigger the potential. Different asset classes move different percentages. Gold moves, 1 or 2 or 3% very slowly, where silver can move 3 or 5 or 8% in a day. So it really varies per asset. And depending on the pattern and the type of risk it might have in a certain market condition, if it's riskier, then you take a smaller position, but the percentage gain will likely be bigger. If it's a very low volatile market, low volatility, things are moving slow, you can put more money into it. You won't make as much percentage wise, but you can put more money in it and make those. So it's a constant juggle of balancing like risk and reward, and just trying to find the sweet spot so you don't get over positioned in any asset class. Because the last thing you want is to have a big position and then it takes a 15 or 20% haircut, and it can do a lot of damage in a very short period of time. So it's all about position sizing, managing risk.
I'd like to get your thoughts on silver as well. The last time we spoke, you said that if silver could hold around $24 an ounce or so, then the next price target would be $34. Is that still the level that you're looking for in silver?
Yeah, so the price target's changed a little bit, but not much. Based on the pullback we've seen from the last time we spoke, the rally and the pullback, it's now pointing to $36 as the next stop for silver. So if silver can break here and start to run, 36 is the next stop. And then it falls into $52 an ounce, which would be an incredible target. But 36 is kind of 36, 34 is the conservative yet exciting kind of upside target to look forward to. And that could happen in a 2 or 3 month window.
I caught your Silverfest presentation over the weekend, and you were mentioning that even if silver goes down to $22 an ounce, that could still be bullish. Can you explain what that means and why that's the case?
Sure. Yeah. So silver broke into a new bull market. It's had a very strong rally coming out of that. If you look at the weekly or monthly chart, it's like a couple big green bars straight up. And as I mentioned earlier, what goes straight up likes to come straight back down because it's not sustainable, that type of growth. So by having this silver trade sideways over the last month and a half, and potentially continuing lower and sideways to that $22 mark, it's actually forming a much larger bull flag that is more sustainable, which means when it does rally, it should hold the new gains. So if it runs to 36, it should actually be able to hold up there and form the next bullish pattern, a bull flag or whatever pattern that will be. So we want something to kind of take its time to get up there. And coming back to 22 will actually cleanse the market, and it'll complete a very nice bullish pattern in ABC retracement that cleanses the market. It gets a lot of short-term traders out who are just in it for speculative. It leaves the investors in it. And then it also allows new investors to move in at a lower price, and they'll hold it for a much longer period of time. So it's a really nice pattern that's setting up. And 22, if it gets there, it might not. That's just the extreme downside that is considered still bullish. If it gets there, I mean, that's a great spot to add more silver to your portfolio.
Are there any signals we could look for that would indicate an up or down move in silver?
It's tough. Silver is a really fast mover. It can have a big red bar or green bar in one day that moves 5 or 8% or more. So it doesn't give you a lot of warning. Typically, you see gold or miners move first, and then silver kind of follows. Sometimes days, sometimes months after. So you really just have to watch the pattern. If other asset classes in the precious metals are breaking out and silver hasn't yet, it's most likely silver is going to follow suit. So you can get into that position early and kind of just wait for that kind of pending breakout to happen.
Looking at the broader picture, you mentioned previously that the markets overall are still going up and investors should be involved. But I think everyone has this sense that what's going on right now can't last. So, what exactly does that look like for you going forward? Is there anything you can anticipate about the decline that many people believe is coming?
Yeah, it's this market. It's scary. It's had such a big gain in such a short period of time. If you look on it on the weekly or monthly chart, it's like straight up, and what goes straight up comes straight back down. So it's very scary. And if you flip that and go to the March crash, that was the same theory. It went straight down and it came straight back up. So we're in this really choppy market. There's a lot of risk for investors putting new money to work right now and expecting long-term gains. They're definitely paying a premium. We're back at 1999, 2000 PE ratios for these companies. We are in bubble kind of territory, all-time highs. So you're paying a premium for stocks. Could they continue to go higher? We're in a bubble. Sure. Fed could keep feeding money into it. And so you can't fight it. You definitely don't want to bet against it yet, not until it's reversed and we have true downtrend in place. But I think adding new money should be more short term, because longer term, I think you'll be able to buy it back at a much lower price sometime in the future, whether it's months or even a year from now. But I think it's kind of really tough money to make from this point forward.
We have an American presidential election coming up in November, and I wondered if there's anything you can say about patterns that you might typically see in an election year. Although, of course, this has been a very unique year.
It is. This year is just it's just insane of how wild things are, and no one's expected all these things happening. The election year brings in, I think, a lot more volatility, and it's gonna, as we get closer to it, every week we get closer, I think the fear of what's going to happen continues to climb. So the markets are just going to continue to get more sensitive. And we haven't had any big news in a couple of weeks. And so we've seen stocks pull back, and the stock market likes news. Yesterday or on Monday, I guess it was, we had merger acquisitions, we had vaccine news, and the stock market rallied, had a really strong start to the week, which carried over into Tuesday. And that's what the market likes. But I have a feeling there's going to be less and less news. It'll be more about politics, more about the election, and it's going to bring huge uncertainty, especially with the stimulus plan. We don't know how big it's going to be, when it's going to be, and so that's got a lot of people nervous. And right now, people are just sitting back, and and that's why I think getting into any long-term investment at this point carries a lot of risk. You might be better just to step back and wait till after the election before you put any real money to work, because you need some direction to know where we're headed, a few months from now.
Great. Do you have any final thoughts or words of advice you'd leave investors with?
Uh, yeah, I think we pretty much covered it. Just be extra cautious if you're a long-term investor putting money in here. I know everyone feels really good and they feel like the markets are strong, and they are strong, but the underlying technicals behind the scenes, the market is very brittle. I was telling subscribers last Monday, I think it was, they said, expect a pullback of anywhere from 5 to 10% in a 2 or 3 day window. And the NASDAQ fell 11% in 4 days. And everyone seemed to be shocked. Yet, I mean, I was warning, there's no support in this market. There's very few stocks holding it up. It's very sector driven. So you've got biotechs, you got technology, you've got certain sectors doing the heavy lifting, but the majority of stocks are not doing well. So it's very touch and go, it's hit or miss, it's a stock pickers kind of market, and it's still very tough to trade.
Thanks, Chris. I think we'll wrap it up there. It's always great to have you on.
Hey, thanks, Charlotte. Always a pleasure.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Chris Vermeulen with thetechnicaltraders.com.